Are you looking to purchase a home today, but wish you could have gotten a lower rate on your loan? Well, what if I were to tell you that even though market rates today are hovering around 7%, you can still purchase a home with a 3.5% interest rate or even lower? Intrigued? Stick around as I go through how that's a very real possibility for today's buyers. I'm Nicole Rueth, Senior Vice President of the Rueth team with OneTrust Home Loans. And before we get started with today's video, if you enjoy our content, give this video a like, subscribe, and leave a comment down below. So getting that sexy interest rate, how's it possible? Well, you likely already know from the title of today's video, but it's to assume the loan of the current seller. So I want to quickly answer these top 4 questions I get asked all the time. What is an assumable loan? Is the contract written differently? How do you know a house has an assumable loan and how do you find them? And then how do you actually acquire it? So let's start out with the most basic. So what is even an assumable loan? So government loans are assumable, meaning the FHA, USDA, and VA loans, not FHFA, which is conventional, nor are jumbo loans. So an assumable loan is defined by a loan that can be, most obviously, assumed by the buyer. Let's go through an example. So if I'm a buyer and I bought a house 10 years ago, and at that time I bought that house for $300,000, I put no money down, I got a VA loan, and I got a fantastic interest rate, whatever that rate was, we'll call it 3%. So I got a $300,000 loan at 3% with a VA loan, no money down. Now, fast forward 10 years, now I'm a seller. And as a seller, I have a loan and I want to sell that home for $500,000. And I had this original loan at $300,000. I paid it down for the last 10 years. So maybe today it has a balance of $250,000. That $250,000 still has an interest rate tied to it at 3%. And I still have 20 years left on my loan. As a seller, I then have the option to market an assumable loan, meaning a buyer has the option to purchase my home, keeping that loan intact. Now, if I want to sell that home for $500,000 and my loan is $250,000, that implies that the buyer has to either get a loan for the difference, has to have the cash for the difference, and that's something that we're going to talk about when we talk about how do you acquire the loan. But the basics of an assumable loan is the terms around that loan stay in place. They simply get transferred from the current seller to the new would-be buyer. So does the contract have to be written differently if I want to purchase that assumable loan? And it doesn't. So contractually, I'm simply buying the house. A real estate contract is going to be focused on the contract of the real estate transfer, not necessarily the loan terms behind it. Now, you might have loan terms to ensure that the buyer is qualified and goes through the steps. And you might want to talk to that lender to get more information, but specifically, you're still going to want to know that the buyer is eligible for a loan and that if you need an appraisal, you have appraisal dates and inspection dates. So the real estate contract is going to look identical to any other contract, assumable or not. So now as a buyer, you've decided that you do want to take advantage of one of these assumable loans. How do you even know if the house you're interested in has one or looking for the homes that are viable for that option? Well, the easiest way, the cheat, if you will, is if the listing agent puts it in the public comments in the MLS. I mean, it's just that simple. I mean, there's more complicated ways to get lists of FHA and VA and USDA loans, but as a typical consumer, that can be extremely cumbersome. So the easiest way is simply to ask the seller, and since the listing agent is working with the seller, asking him if they have an FHA, USDA, or VA loan, and putting that in the comments along with the word assumable loan options, so that you know as a buyer, you can search on one of those terms. Then, of course, the last question is probably the most important. Well, then how do I even get it? I like the idea. I like that I can take a loan that's locked in at a lower interest rate. I like that I've contracted and I can even find this out after. It's as easy as it was typed in the contract or in the MLS. So now, how do I get it? Here's the trick. You can't use your typical or preferred lender. You have to go back to the lender or the servicer who's holding the loan currently. They have to approve you. They have their own assumability options and process. So you'll want to contact that lender as quickly as possible to find out if they'll require an appraisal or if they'll waive it, the amount of the loan that you can assume and the terms and the interest rate. And then if you need to bring more money to the closing table or if they'll offer you a second loan to make up the difference. It's all based on that lender and that servicer and their terms and their timeline. Well, I certainly hope that helped. And if you have more questions, please feel free to reach out to me, or even better, add the comments down below, because we'd love to start the conversation and answer those same questions for others.